Welcome to the John Sanchez Show on News Talk 780 KOH with Dwight Millard of On Q Home Loans and Aaron Clark of Edge Realty. All right, once again, very volatile session, more so on the Dow side. Even though the Dow finished with a modest loss, with a modest gain, the Nasdaq again was under pressure, but had nothing to do with this situation, as I said. So overnight, to finish up on this story, overnight the Iranian military, they haven't claimed that they've done this yet, but the U.S. is saying it finally. Trump said no, it wasn't Iran, and now they're saying that it is. Iran downed an Apache helicopter again. The two crew members got rescued by a U.S. military drone boat, so they're safe back at home. But Iran said about an hour ago, foreign forces in proximity to our territory are at a constant risk on account of their own human errors, plane accidents, or potentially being caught in crossfire. To reduce risk, best solution is for them to leave, adding, we prefer language of diplomacy, but speak other languages too. So, again, this news broke during market hours. Market just brushed it aside, thought for sure it would be a catalyst for it to go down. It didn't. Matter of fact, oil prices, it really is. Oil prices actually plummeted today, down $3.10 to a close of $88.16. So once again, very Teflon, i.e. resistant market. Here's how we finished up for the day. Dow gained 86 points after, again, being down triple digits, up triple digits, finished just with a very small gain of 50,872 was the closing level. Nasdaq, we saw, and it happened mid-morning, no news behind it. All of a sudden, the chips reversed, the chip stocks, the semiconductors, just like we saw on Friday. It looked like it could very much be almost a bloodbath like we saw on Friday. Nasdaq ended up reversing. Chip stocks still finished down dramatically. Again, no news behind it. But the Nasdaq finished down 251 points, 0.97% loss to 25,678. And the S&P down 19 points, 0.25% to 7,365. Gold prices down $72.76 to 4,290.60 an ounce. And 10-year Treasury, Mr. Millard, 2 basis point decline. 453 was your 10-year close. How did we do on the 30-year mortgage?
Well, yeah, so John, I mean, go figure. When you miss a day on the radio, everything goes backwards, right? I mean, we're unchanged is the good news, but 6.68 on the 30-year fixed average. I mean, I think it was just a week and a half ago, John, we were talking, we might get inside that 6.5.
Yep.
Now we're at 6.68. I mean, and it was on a day that was actually okay. We didn't get, the mortgage-backed securities were okay, but so on an okay day, we go up.
How did you, and I don't remember on Friday, I have to go back to my notes, how the 10-year Treasury yield did on Friday when we had the big market sell-off. I'm thinking you probably saw rates, believe it or not, going up. Do you remember?
We did. Rates did go up. Yeah,
they did go up. Yeah,
I don't remember what the 10-year did, but yeah, rates went up. It was.
Which again makes no sense because it should have. Friday was, like I said, a bloodbath. It should have been a flight to quality, which buy the bonds, yields go down, but the opposite happened there. So let me ask you this: let's say, as I keep saying over and over again, I don't see a quick end to this war. I don't trust Iran. Obviously, I don't trust their relationship with Israel. It's gone too far. They're too deep. Something dramatic is going to have to happen. And I hate to say this, but it's just my own personal opinion. Let's say this conflict escalates, Dwight. What's the mortgage world predicting at this point? Are you seeing any modeling going on out there that says, if this war escalates, this is what we can have happen?
John, I think the best indication you get is from some of those Fed members that are breaking away saying, hey, we may just have to raise rates. And I think that's kind of the sentiment throughout the mortgaged world is that, we may be higher than higher for longer than longer, right? I mean, remember that's what we've talked about. I mean, it's the double now. I don't know. Aaron can speak probably to the activity. There feels to be some good activity, but I think it's more, hope and a prayer type of activity. I'm going to go out and hope that rates come down and pray that they do. So I don't know if they're getting solid and serious.
Dwight hit it right on the head. That was a question I was going to pose to you, Aaron, is you're saying things are getting really, really busy out there right now. What are you hearing from people? When it comes to everything from the price of the house to, hey, I'm pushing almost a 7% mortgage, but hey, I can, always refinance at that point. What are you actually hearing in the field these days?
So people that are margins, where they're right on the edge or the cusp of being able to qualify for what they're looking for or not, they're getting pushed out because they're getting pushed all over, right?
Okay.
So a lot of those guys are just kind of sitting back on the sidelines right now and saying, okay, I'm going to wait till either things stabilize
Mm-hmm.
or the market changes, because we're kind of in the run up of the heading towards the busiest part of our season right now.
Right.
So we
Right.
have the natural ramp up that sort of gives us a little extra support.
Mm-hmm. Mm-hmm.
But by no means is it crazy or anything like that. Good stuff is moving with a couple of maybe like multiple offers, but two, three, four, nothing crazy. But the
Okay.
stuff that's pretty similar to everything else on the market, it might sit for a while unless it's competitive pricing or it's been updated or something like that. As far as, go ahead.
I'm sorry to interrupt you just real quick. I had a phone call today with a good friend of mine who's a yacht broker down in Newport Beach. I mean, one of the wealthiest areas, if not the wealthiest in the world or in the country, right? And he was saying, yeah, of course, higher fuel prices are a problem, but he's saying yacht sales. Obviously, you're dealing with the upper echelon of economic society. He said they're just terrible right now. They're just terrible. People, exactly as both of you have said, people are saying to him, I'm just going to wait a little bit. I'm just going to wait a little bit and see what happens. Many of them being in California, the political side has just got everybody freaked out there. But on a more national basis, yeah, he said they're just a lot of people just sitting on the sidelines. Prices of yachts keep coming down, 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 and they're still not buying yet. So interesting on another high level asset class there.
Yeah, exactly. And we are seeing that with more of the higher end pricing
Are you?
homes where
Oh,
they're
okay.
sitting
There you
longer.
go.
I, uh, and when I say the higher end pricing, I mean not the tier that probably isn't affected too much by
Right.
anything, but just below that
Yeah.
higher price, your mid 1 mil, to
Mm-hmm.
you're
Mm-hmm.
seeing a little bit of pullback there. And like when Corey was talking about last week, the report for the month of May,
Right.
and how
Right.
we're talking about the increase in the median sales price. So much of that is driven by just a few of those higher end homes that are still moving, that are pushing those
Mm-hmm.
numbers because you just have
Mm-hmm.
so much
Yes.
less action. So
Yes.
it's really not a positive indicator as far as like if you know how to read the report of saying, oh my gosh, the market's on fire, blah, blah, blah,
Right.
blah. Like you have to look at all the numbers, the new homes that are coming on, the homes, how long it's taking to sell, etc.
Well, like Corey said, if you throw out, he said there was a handful of those higher end homes. I think you said one was 5 million or something like that.
Yeah.
Yeah, if you throw out that probably that top top five, and then get down to the numbers, I bet we wouldn't have been at a record median price as the report
No, we
indicated.
would probably be less than what we
Yeah,
were. It would be my
yeah,
guess.
that's kind of what I'm thinking too. Interesting. All right, so you're now up to date. What's going on a local basis, the mortgage side. Now let's get into some strategies when we come back. Once again, how one rental property can become a multi-million-dollar portfolio if you do it right and you watch the tax side of things. We're going to share those strategies with you with Aaron and Dwight. All right.
Yes.
Yeah.
Welcome back to the John Sanchez Show on Newstalk 780 KOH with Aaron Clark of Edge Realty and Dwight Millard of OnQ Home Loans. All right, once again, interesting day in the market. Let's just put it that way. 86-point gain on the Dow. NASDAQ lost 251 due to weakness in number of chip names specifically. Drug a lot of the NASDAQ down. S&P down 19 points. Now, let's get to our topic once again, how one rental property can become a multi-million-dollar real estate portfolio if you follow the right strategies. So let's get down to this, guys. There's a lot of things we need to cover. So remember, I'm going to use a saying, why bigger can be better. Okay, I'm going to kind of start this thing off. So, Aaron, Dwight, here's the reasons, right, that you guys listed. Number one, most investors start with a single property, right? Kind of cut your teeth. It's easy to understand the financing. Management, not too bad, right? You got one property, most people can handle that. But you get into more properties, equals more maintenance, equals more repairs, equals more tenant issues. Apartment buildings and commercial properties often benefit from the economies of scale, however. Like I said, 10 rentals you have, single family, that's 10 roofs, 10 AC units, so on and so forth. Get into a 20, 30 unit apartment building, you only have one roof, and so on and so forth. Professional management becomes more affordable when you get into the commercial side, and investor transitions from landlord to business owner. It's a different mentality when you own commercial. Now, Aaron, I'm going to turn it over to you. Let's talk about what you guys have highlighted as what's called the power of scaling. Talk to me what you mean by that.
Well, I mean, when you're scaling through buying investment properties and you're going from buying, let's say, one single family residence to a multi-unit complex or
Hmm.
whatever, um, obviously the things that you hit are key perspectives, but you're not having to keep generating that down payment over and over and over again for multiple single family residence properties. And that's
Great
one thing
point.
that people,
Great point.
a lot of people don't understand, that
You're
is
right.
when you're buying a four unit, I mean, if you can do it from the perspective, and a lot of people do this even later on in life,
Hmm.
you can buy a four unit, 20 unit, whatever it is. You can buy something that you're going to also live in, and you can,
Yeah,
especially with
Dwight's going
like
to
a
cover
four
that.
unit.
Hmm.
Yeah, it's a great opportunity to come in with very little down payment to get into something. And then you can also
I,
take
I,
all
I
of
want to
that.
stop you. I got to stop you because you
Yeah.
hit on a point that I don't think you think is important, but it is important. Let's go back to the down payment. Okay. So let's go over the strategy once again, right? You meet with Dwight. You buy your first single family. You meet with Dwight. Dwight, what are we looking at? 3.5 to 10, 20%, depending upon circumstances, kind of a range, right?
Just on an owner occupied, on a
Owner,
primary.
no,
Yeah.
non-owner occupied,
No,
a
no,
single
no.
family rental,
Yeah.
single family
At
rental.
minimum, you're going to be 15, but most traditionally, John, is 25% down. That
Okay.
gets you, that's the best, term.
So, okay. So, Aaron, I want to go back to you because this is important. All right. So let's make the numbers really simple. We said last Thursday with Corey, our median price now 615 and some change. Let's say we're at 600,000 just to make the numbers simple. Dwight says, okay, great, got good credit and everything, but I need 20% down, so I got to come up with 120 grand. Okay,
Mm-hmm.
that's just the down payment, not to mention the right, Dwight, the closing
Yes,
costs and
correct.
reserves and on and on and on.
Right.
Okay, so I do that. I somehow, some way, I come up with that. Now, I own it. A couple years go by, and maybe I'm making a few bucks on the cash flow each and every month compared to my mortgage and my other expenses. But man, my appreciation happened, right? That $600,000 house is now worth whatever, 750. And I go, I just made $150,000 worth of equity. Didn't cost me really anything. I'm not making much cash flow, but man, I've got this appreciation and I haven't had to pay tax on it. Now, Mr. Clark, multiply us from there.
Yeah. So now what we can do is we can take that approach and go into what we would call a 1031 exchange, for example, and we can take that money as well as the sale of that property and we can parlay that, if you will, into like a 2 unit or a 4 unit or something like that. So now you're using that same strategy to grow. You're not selling the property and putting that equity in your pocket to where now you're going to be paying Uncle Sam their X amount of percentage.
Yep.
You're taking that money and you're deferring the taxes. And the reason that the government gives us this ability to do so is because when you parlay that into something greater, bigger, better, you're also investing more into the economy, into the city, into the tax
Mm-hmm.
basis and structure. You're bringing in more people for housing. So they look at it as like, well, you're benefiting. So,
Come
you
on,
know,
you cut the crap, dude. It's about the lobbying efforts of your industry
well, of course it is.
Yeah, yeah.
Of
the
course it is.
government's not going to give us anything free, but
Yeah, no, but that's the idea behind it, as to
yes,
why we
at least
get
that's
to
what they
keep
tell the
doing that.
public.
And I've had people where they have 5, 6, 7 homes that they've
Yeah,
acquired over 20 years,
yeah,
and now they're looking in retirement world. We sold all of them and bought a gas station in Texas that
that's
pays them
right.
$20,000 a month on
That's
a
right.
60-year lease, and they have
That's
to do
right.
zero,
Zero.
zero.
And
They didn't
again,
even pay to put the building on the land.
right, right. There
That
you
was
go.
it.
Okay, you just moved us right into the 1031. I thought it would be a little bit later in the show, but you've opened the can of worms, so let's explore this. Okay, Dwight, we've got to talk about the 1031, right, Aaron? Let's lay out the rules. If you're not familiar with it, 1031 is a tax deferred exchange. Many of you know about it, some of you may not. Very stringent rules you have to follow. So, Aaron, take it away. We got our 45-day, our 180-day rules, but what else do we need to do? And talk about like kind transfer, which is not really the case.
Yeah, so I mean, you can't roll that money into a property that you're going to move into.
Right,
A lot of
personally.
people go, well, can I buy a vacation home in Hawaii? No, you can't do that. Also, you need to buy something that is an improvement from what you had. So you need to increase the amount, or increase
And
the
let's stop right
size, or
there. You sell
increase.
a property, investment property for 700,000. You better buy something worth $700,000,
And one.
$700,001 or greater.
Yeah.
Yes, or
Hey,
the
can I ask a question real quick, John? So,
Yes,
Aaron,
sir.
if you take the 700, can you 1031 the single into, let's just say you're
Absolutely.
into a multifamily, and you can't live in one,
Yes.
correct? But you can't live in one. Is that correct?
No, you can't.
No.
Yeah.
Because
Okay.
you're
Want to make sure.
then it's no longer an
Right.
investment.
Right.
It's you're breaking,
Yeah.
it's like the whole, what is it? What's the term? Crossing the corporate veil or whatever.
Yeah.
It's
Yeah.
kind of
Yeah.
like you're doing that whole
Yeah.
thing. You're intermingling your personal with your business. So no,
Right.
you can't do that.
Right.
So yeah, you take that 1031 money and you roll it into multiple properties or whatever. You can also attach a loan with that 1031 money. So a lot of people go, well, if I only have $300,000 in equity and I want to parlay that into a gas station or whatever, or a complex, I don't have enough cash because it's $1 million and I only have 300,000. You can get a loan for the difference of what you don't have is, and that money that you're transferring over is still tax deferred.
Hey, John, I want to touch on that real quick because Aaron is absolutely right. Why people 1031 into something like that and don't expand that denomination of cash? I mean, you've got maybe 4 or 5 separate down payments into multiple properties, but they get hung up, right, Aaron? They get hung up. Oh, I got 700. I got to go buy. No, you can get a loan on all of it. There's your down payment. There's every.
Yeah, you can use that 300,000.
And I get to use the rent credits against the payment.
Yep.
Yeah, and you can use that 300,000 in our hypothetical situation of equity, and that can just be a down payment on a multi-million-dollar 25 unit complex.
Did the client pay a dime of tax for that strategy, Aaron?
What's that?
Did the client pay a dime of tax for that strategy? Zero.
Goose egg.
Goose egg. That's exactly right. So the flip side of it is we have what's called boot, right? So in our example, client made a $300,000 profit. They 1031 exchange it into a big commercial property. Cool. We understand that. But let's say they couldn't find, let's say they sold at 700. So they got to buy something, over $700,000. But we all know, and we all have clients where we're seeing this. We're seeing people coming out of California, Silicon Valley, et cetera, San Jose, et cetera. They've bought their homes, their rental properties. They built up a real estate portfolio. I'm dealing with one right now. Back in the 80s, cost basis is like next to nothing. They're rolling these multi-million-dollar, usually 2, 3, 5, who knows, however many properties. And they're coming here. And the dollar goes a long ways. What I'm seeing is, and correct me if you guys are seeing the same thing or not, they're not able to spend enough money, right? Because you got to remember, folks, let's make the number simple. You come out of California, and let's say that your whole portfolio is worth $10 million, $10,200,000, right? Or 10 million, $10,200,000. They come here, let's say they're able to buy a great portfolio of 10 million, that $200,000, they don't know what to do with it. Now, what happens? That's called boot. They got to pay income taxes on that money, capital gains, which again starts at 20%, and you can add another little over 3% if you're in a higher income bracket. But they got you the depreciation recapture tax, which is 25%. Easy bottom line, if you're in a state that has taxes like California, you can wipe out 40% plus of your gain. 1031, you can't. But remember, if you don't invest every single dollar, whatever you don't invest, that's called boot. But when we come back, I've got a strategy for you that, and I'm not saying this to criticize you boys, I love you, that Aaron can't do and Dwight can't do, but I can as a registered investment advisor. And I'll share that with you when we return. Great point, boys. So. Welcome back to the John Sanchez Show on News Talk 780 KOH. Let's get some phone numbers going, boys. Mr. Edge, let's start with you. Or Mr. Edge, Mr. Clark, let's start with you of Edge Realty. I'm looking at Dwight and I'm saying your name. Wait a minute here.
It's the same number.
It really is. Yeah, kind of.
673-6700.
Beautiful. Mr. Millard.
240-2022.
Perfect. All right. We're talking about how one rental property can become a multi-million-dollar real estate portfolio. We need to do a show, guys, as we were discussing during the break. We need to do a show just on 1031 tax deferred exchanges because it is very important. Now, I got to be really careful what I'm about to say because this is a very compliance sensitive area. But I gave the example. So in 1031's a portfolio, doesn't matter how big, I just use $10 million, but they sold $10,200,000, $10.2 million they sold, but now they only bought $10 million worth of properties, right? They just could not find for that smaller amount. Well, if they want to pay taxes, capital gains, meaning depreciation, recapture, et cetera, on that 200, they're more than welcome to, but a lot of people don't, right? They want to do a 1031. So we in the industry, you have to be a licensed financial advisor, and I mean like we are, a SEC registered investment advisor. Some broker dealers offer this also, is what is called a Delaware statutory trust. And I promise you we need to do a show on this and probably a separate podcast because there's a lot to know about them. But what they are essentially is you are pooling your money. In this example, that 200,000 that Aaron couldn't find a home for, right? He got your $10 million invested, but he couldn't find a home for that 200. So we 1031 the 200,000 in this example into a DST, or Delaware Statutory Trust. What that is, it's a portfolio, a institutional level portfolio managed by an institution, right? Institutional investor, institutional real estate company. What they're doing is they're then pooling that 200,000 with other investors. And depending upon the size of the project, if it's $100 million project, I mean, you could see 50, 100 other investors. You have to be an accredited investor, meaning a certain net worth, a certain income, which, a lot of people can qualify for. It's not that hard. But it's a way to get a 1031 exchange without physically going into another piece of property. So you take that 200, you 1031 it into the DST. They then take it and they will then pool your money with everybody else, and they go out and they buy investment real estate. Generally, they already have a project. Usually, like Dwight knows about this one. Dwight spent some time last year in Oklahoma, and we recently did some student housing in that area. So it really varies. We have another one that we've done. What was an Amazon fulfillment center. So the problem is you're locking your money up, usually 5 to 7 years. But in most cases, you're getting a monthly check. But the most important thing, you're tax deferring, you're 1031 exchanging that money. I have some clients, right? My clients tend to be a little bit older. They don't want to do real estate anymore. They just want that monthly check coming in, no phone calls. DST can work with that. Again, there's pros and cons to it like anything else. If you got any questions, just give me a call on that and we can discuss it. But guys, this is how it's done, right? And Dwight, you know what? I want to follow up on this topic on Thursday because we get into the financing side of it. We didn't get a chance on that side. So beautiful job, boys, as always. We will do it again tomorrow on the John Sanchez Show.